important. In the book 13 Bankers by Simon Johnson and James Kwok, quietly in the middle, there is a small moment, and I believe it was 2004, where the banks went to the government or the SEC or whoever and said, hey, it's no fun, we can't make money, give us more leverage. Simon Johnson nails that in 13 Bankers, and we're having the same conversation here as we enter May of 2013. This is an important point. They said, we can't make money, we need more leverage. Nothing's changed, has it? They're going into a mode of we can't make money and we need a new set of rules.
That's exactly right, Tom. They want to run a business that's highly leveraged. That's good for them because they're paid based on return on equity, unadjusted or insufficiently adjusted for risk. So they get the upside, and the downside is someone else's problem. That's a very bad deal for the rest of us.
Is that changed at all? We see Dodd-Frank, which is really beginning to come into the process. We see the Basel debate over in Europe about how much cash they should hold. It's their lobbyists against the politicians. Who's going to win that tug of war?
Well, in terms of the arguments, in terms of the intellectual arguments, the side in favor of more capital, more equity in the bank system is doing very well. The new book by Martin and Martin Hellwig, for example, The Banker's New Clothes, is having a lot of impact.
Diamond's bedside.
I'm sure all 15 of his lieutenants read it right before they quit J.P. Morgan. That's good. On the other side, the lobbyists, the money, you wouldn't believe, Tom, every day the number of people in the offices of senators and congressmen saying, we must have more leverage, we must have more leverage. Don't do anything.
And this is critical, sir. I know you want to jump in here, but this is 2004 redux.
But what's different now is that the calls to end too big to fail are growing louder and louder, and you're actually seeing some concrete proposals, including one just last week, on how to shrink or potentially even break up the big banks.
Well, the significance of the proposal last week from Sherrod Brown and David Vitter is that's a Democrat and a Republican cooperating on a very sensible proposal to increase the equity capital requirements, particularly for global mega banks. And
increase capital requirements to 15%.
Absolutely.
And so you say it's caused a shift in the banking behavior toward Dodd-Frank.
Well, banking behavior has shifted because they didn't do well in the last electoral cycle. They backed Romney. They were against Sherrod Brown. They were against Elizabeth Warren. So they didn't get the outcomes they wanted, and the banks are now on the defensive without question. But the lobbying power and the money they can put into campaigns is still enormous.
Let's go to Simon Johnson's op-ed from last week, a very important statement here. The reality remains the same. A very powerful lobby is working flat out to ensure that the industry, the banking industry, keeps its dangerous, non-transparent, and unfair subsidies, yet the winds are shifting against the mega banks. Which wins are those?
Well, it's what Sarah was saying. It's opinion, informed opinion. If you talk to, let's say, senior people at the Fed, not unfortunately the Treasury, but at the Fed, people are increasingly concerned about exactly what you identified, what you were talking about. Are we back in 2004 already with crazy amounts of leverage, and we're going to pile it on us?
What is wrong?
But here's the problem, Simon. If the U.S. goes at it alone, Dan Tarullo at the Fed and the other regulators here with too big to fail, then the Europeans will scream. They've already written to Ben Bernanke that protectionism is a threat here if we have this competitive gap.
Look, Sarah, if you're waiting for the Europeans to sort out their banks, you're going to wait a long time. If you regard European banks as a model that we should copy, that is the road to disaster. There is nothing good about the cooperation manifest in Basel.
Simon, 358 pages by J.P. Morgan a couple weeks ago on the future of your banking industry. Fabio Valentini out of our Paris bureau writes about BNP and SocGen today, about how the French are taking a different path. It's a more conservative, cautious path. You've got the Europeans like Deutsche Bank with a cash call. Isn't that the solution, just more capital? Why do the bankers fight against the common sense idea of just more capital, more money in the piggy bank?
They say they are better capitalized.
They are, I'll go.
They are.
But others say we need even more just to be sure.
Look, under Basel III, you can have 3% equity, 97% debt. This is a thinly capitalized financial system. And the answer to why the bankers don't want to raise capital, increase their equity funding, Tom, is all about compensation. They are paid based on return on equity, unadjusted, insufficiently adjusted for risk. So, of course, they want to gamble. They want high leverage. They do better when things go well, and the downside is not their problem.
It's not that what they say, that they're not making as many loans or helping the economy as much.
No, it's not. Those complete fabrications, Sarah. This is propaganda posing as research. And unfortunately, we see it not just from the banks, we also see it from people like the ratings agencies who really at this point should know better.
if we raise more capital, I just don't see the downside. They go out, they do a cash call. J.P. Morgan, if they raise more capital today, there'd be a stampede, as frankly there appears to be for the Deutsche Bank deal. Is the fear here that there'll be too fewer banks if we force them to raise more capital? Will there be a consolidation, almost an Andrew Mellon-like moment from the 20s and 30s? Fewer banks, better capitalized?
No, I think it would go the other way, Tom. I think what's driving the continued move towards concentration is the fact that big banks can get away with running these highly capitalized, highly leveraged, very risky businesses. If you level the playing field, which is what Brown-Vitter wants to do, and that's why the Republicans and the Democrats are agreeing. To the Democrats, this is unfair, unfair and concentration of power. To the Republicans, it's a distortion of the market. They're both right. We need more markets. We need more ability of companies to fail in order for the market to function. That's going to happen if banks are smaller and if banks
But you just described the power of the bank lobbies, how they're there every day with so much money. Do you think this Brown-Vitter, yes, it's bipartisan, even has a shot at seeing the light of day?
There is a growing support for this legislation in the Senate. It depends on events. It depends on what scandals you see. It depends on how Europe unfolds. I would suggest, what are we going to see in the European banking system?
10 seconds. Would you buy J.P. Morgan here?
No.
Okay, we got that out of him. Simon Johnson with us, and we will continue. Spirited debate. We're going to look at austerity here in the hour.